Hello, welcome back. So, we're having some important news coming out from Walmart, which seems to have slashed their guidance for the second time, mind you. And the stock right now is down about 10% in the pre market. It's about 120 bucks, potentially being a very interesting opportunity here. But we're going to examine all this. First things first, let's take a little bit of a look at what Walmart said about their upcoming earnings. So they cut profit outlook as inflation forces shoppers to spend more on necessities. That's definitely understandable here. I mean, as we're entering a recessionary environment, potentially, people will tend to be buying the things that matter most. This, for example, is food, and will actually cut down on costs that are about all the items that we don't necessarily need, things like cars, electronics, and things of that sort. They are not first necessities, and so this is what people cut down on, and this is what we're seeing from Walmart right now. Now let's actually see the finer details. So they did cut their quarterly and full year actually profit guidance, saying inflation is causing shoppers to spend more on necessities, of course, and this is what we talked about. Now, we are actually seeing that Walmart anticipates adjusted earnings per share for the second quarter and full year to decline around 8 to 9% and 11 to 13% if we're talking about the full year decline here, which is very, very substantial, as you can understand, because previously it had expected them to be flat or maybe a little bit higher, like 1%. So this is a massive difference here, pointing to pretty much consumer, the consumer confidence becoming worse and worse, and that's definitely not a great sign to see, especially from a discount store like Walmart. And as you'll see here, you will see that Walmart said it now expects same-store sales in the US to rise actually by about 6% in the second quarter, that's excluding fuel, and this is higher than the 4 to 5% anticipated. But again, this is probably going to be more about food and other necessities, really. As you can understand, selling food has much lower margins than other items like TVs, clothing, and things of that sort. And so, this, generally speaking, points to a downtrend, upcoming downtrend in the economy, and it's obviously not a great sign to see here. Now, you will see, for example, that Macmillan has said Walmart can gain market share and more customers' wallets during the inflationary period by emphasizing good value. And he has mentioned that the discounter shop, basically Walmart, will keep prices low. And Target also slashed its forecast for the second quarter. That was last month. And during this kind of announcements, a lot of these companies, these discount stores, and basically retailers are going down. Like Target is down 6%, Amazon fell more than 3%. You can see here the finer details. Now we do expect the company to report August 16 about their second quarter results, pretty much. So we will be seeing what they're going to be doing about that when it's August 16. Now, as the company stock price is going down more, it pays to take a little bit of a closer look at what they are doing financially and see whether this kind of price, 120 bucks, makes sense for us to buy, or we should be waiting a little bit more. Now, taking a look at the 5-year chart, this company hasn't fallen a lot compared to the rest of the stock market, because that's what happens with discount stores. If we have a recessionary period, they do lose some value, but they don't lose as much value as a lot of, for example, tech companies will be losing like 70%, 80%. These kinds of stores may lose like 25, 30% or something like that. Although the 25 or 30% is probably going to be the case tomorrow when the markets open, actually today. So the P/E ratio of the company is sitting at 28, yet it's going to go down by 10% when the markets open, it looks like. And so we're going to be seeing a better value here. And in terms of the price to free cash flow ratio, again, to 32.7. Outstanding shares are going down, so the company has been buying shares back, at least before this happened here. And the total liabilities that the company has are a little bit elevated compared to free cash flow. This kind of debt could be normal for these companies, but for a company of this sort. But generally speaking, it's not a good idea to have that much debt compared to your free cash flow. Now, a behemoth is Walmart, and this is why their revenue growth, net income growth, for example, doesn't grow that much over here. and its free cash flow is actually going down. This is not a pretty sight to see, of course, because this can actually deeply affect the dividend payments as well. And in regards to dividend payments, you will see that the dividend yield is not that high, it's 1.7% almost. And in terms of the free cash flow payout ratio, I'm assuming because the free cash flow is going down, we're getting a little bit of a higher value, 55%, which is definitely not something that would forbid me from investing in the company, yet it is a little bit concerning. I typically like to see maybe 30% or something of that sort. Now the net income payout ratio is a little bit better, but still we're looking at near 50s. And the net income margins are getting more and more suppressed, and they may get even more suppressed as the company will be struggling to sell like food and other necessities really. And the return on equity has been at an okay level, 16%, not bad at all. And the next thing that I want to be examining about this company is the dividends. Now, what are they doing in terms of the dividends here? So this is a quarterly dividend that they are paying, and the current dividend yield is 1.7% if we take a look at the price. But again, remember the stock market, when the stock market opens up tomorrow, it's going to be 10% down, so this dividend yield will be affected and it's going to be a little bit higher. So it may be 1.9% or something of that sort. Now, you will see that the company has been increasing their dividends through the years, through the quarters pretty much, although not as steeply as in the previous, some of the previous years, as you will see. But still, they have been increasing their dividends pretty much steadily. And that's a nice sight for somebody who wants to invest for income. Now, the company's yield is not high; it's 1.7%, so it's not high at all. And so I'm not really, I'm not really keen on investing potentially on something of that sort just to gain the dividend, just because it's pretty low, and the company cannot really afford to make it much higher, because it will affect their free cash flow significantly. So yeah, it's a little bit of a dire picture, I suppose, in terms of the dividends here. Now, you will see that in terms of the split history of this company, they have split their stock multiple times in the past. So this, generally speaking, points to the company doing pretty well through the years. And the fact that they are splitting their shares, it means that the stock price is going higher and higher, and so they are kind of splitting it to make it more accessible for people. So over the years, and again, if you take a look at the max chart, for example, you will see that the stock has been performing fairly well, very well actually. And it's been one of these stores that typically goes up in terms of its stock price. And in the booming period, where the stock market was doing better and better, it was also doing better and better. And it's kind of having its slump with the rest of the stock market these days. Okay, so what I want to take a little bit of a look at is, I'm a little bit curious to see what's going on with the cash flow, the income statement, for example. So in terms of the revenue, you will notice that we're going from 500 to 572, which may not be too high, yet we're talking about a $500 billion company. So increasing revenues is a great thing overall. Now, we do know that they're going to be decreasing, they're going to be having declining revenues, at least for the next few quarters. So maybe this kind of revenue growth is going to be in the negative. Now, in terms of their net income, 9.8 billion to 13.7, even better here, an even better picture, achieving better profitability compared to their revenue here, it looks like, in terms of a percentage, that is. And so in terms of their balance sheet of the company, which is not really issuing any shares, they are still having a pretty high amount of equity, from 80 billion to 91 billion over here. And that's great to see, and total liabilities of 153 billion, that's pretty high. It's more than the total equity here. And if we take a look at the cash flow statement, you will see that the free cash flow is at 11 billion. This is why we saw the high multiple earlier in terms of its free cash flow compared to the company's total liabilities. Now, this free cash flow has definitely been affected by what has happened in the previous years with the pandemic and all that. So the company hasn't been doing as well, it looks like. But if you take a little bit of a closer look, you will see that they have been spending quite some on inventory. Now, this actually can be a little bit of a tricky business here, because what happens with these kinds of stores is, when people get their stimulus checks, people start buying stuff, and so a store of this sort needs to have extra inventory, and so they thinking that people will keep on buying, they purchase extra inventory, and this looks like what has happened. And keeps on happening for now. And when this happens, and the stimulus checks are cut, and people don't have enough money actually to spend, then the company actually has some stagnant inventory here that they cannot really sell. And this has deep implications in the economy, because now your suppliers, like Walmart suppliers, will also potentially have created extra inventory that they now cannot sell to Walmart. And so this kind of creates a rippling effect really in the economy, making things potentially worse. So seeing this kind of inventory go higher and higher, and the company purchasing, spending a lot of cash, really a lot of cash for inventory, may not be the greatest thing here for Walmart. May have been a misstep really. Now I don't know the finer details, but I'm just thinking out loud here, and this is what caused the change in the operating cash flow here. Now the cash from investing activities is in the negative, because the company has been still repurchasing common stock and of course paying some of their dividends. It's a pretty high dividend payout ratio, as you'll see. And the cash that they have at hand is about almost 15 billion over here. Free cash flow at 11 billion right now, I guess, again, because of the operating cash flow that has been deeply affected by the inventory. If they haven't spent that much on inventory, we would be looking at a like $22 billion free cash flow or so. Now let's take a look at the stock evaluation tool and see what kind of price to pay for this company. Yeah, and revenue growth has been in the positive numbers for the past few years. But remember what we just read in the article. So they are anticipating that their earnings per share for the second quarter and the full year especially, they will decline by 11 to 13%, which is very high. And so they don't really mention here what will happen in terms of revenue, but we need to be very, very conservative here and go in negative territory and see what we will get out of this one. Now, they may be affected just by 1 year, so it may not have tremendous effects, but we need to account for that. So I'm gonna try to go very low here and see what I'm getting out of this one, just for the sake of the experiment. I'm gonna go minus 7%, minus 3%, and then I'm gonna do a marginal revenue growth that is in the positive numbers, 1%. So let's see what we're getting out of this one. It's an interesting case study. And the net income margins, I'm gonna go low as well. I'm gonna go 0.5%, 0.5, 0.7, and 1 is where I'm going. Again, I'm trying a very, very pessimistic scenario here, and which I can actually change a little bit later if we get into more confident cases. So we can try just a few things here. And I'm gonna go with 80, 90, and 100% in terms of its free cash flow margin here. An annual return of 13% is what I'm gonna be aiming for, and let's see what we're getting out of this one. Now, out of this one, obviously, we're getting much, much lower values, because if our revenue grows minus 7% and we basically make no money, then we're going to be getting very, very low estimates in terms of the free cash flow that the company is going to be generating, which is probably not making too much sense here. Again, because when this happens, the company is not really making money, and our model here goes into negative territory. This is why the company stock price gets down that low. Now, of course, this kind of scenario, like minus 7% for the next 5 years, is gonna be unlikely. In which case, yeah, it wouldn't make sense to be buying the stock. But what happens if, let's just go a little bit more positive and still be cautious, like go minus 2, 0, and 2 here, and the net income margin, I'm gonna go a little bit higher, 1.5, and 2. This, I think, has a much, much higher chance of happening potentially, and even this one could be a little bit pessimistic. But let's try this one as well and see what we're getting out of this one. Again, these are case studies just to see where we are in terms of Walmart's price and what we're aiming to achieve in the next few years. In this case, we are looking at a high of 59, and our current price is going to be at 120 pretty much. And our high is actually making a lot of sense here. I think this one is probably the number that makes the most sense over here. 2% in revenue growth, 2% in net income margin, and 100% in pretty much free cash flow margin. So I think this scenario is the one that probably makes a little bit more sense. Maybe 1% would also make sense here in terms of our revenue growth, just because we can go a little bit lower in the next few years. And in which case we're going to be getting again a $57 valuation. So yeah, the company's stock price is still elevated. It's still expensive, compared to what the company is generating, and you can kind of get a hint from this one in terms of the P ratio and price to free cash flow. Now the thing is, if the company stock price keeps going down, it may become a more interesting opportunity here. If that continues to happen, this kind of decline, and we go below like 80 bucks or maybe something of that sort, then it kind of becomes interesting, or it starts becoming much more interesting to me. So yeah, that's what I wanted to talk about in terms of Walmart after we got today's news. It's an interesting store that we need to be cautious and wary about, because as it goes down, it may provide some nice value. It's a signature store in the US, signature discount store. So thank you for watching again. Remember to leave a like and subscribe, and as always, if you are interested in becoming a member of this tool, you can find links in the description box below this video. Thanks for watching again, and I'll see you in the next one. Bye bye.